So the other thing that is very peculiar, I think, to a certain extent in this part of the world, and maybe even in Southeast Asia to some extent, is this fondness for structured products, which is essentially products which convert movements in underlying assets into an income stream. What most people don't seem to understand, and I guess partly they've lucked out because the markets have mostly been helpful so far, is that they are actually taking on all the risk for a little bit of return. They are the ones who are providing the insurance.
Yeah.
In the structured products, they are the ones who are providing the insurance. In case things go wrong, they are the ones who are taking the risk. And they don't participate in the upside. Somebody else participates in the upside.
So today we have the pleasure to be hosting a fantastic guest with some deep industry knowledge, Biswajit Dasgupta. Biswajit is an industry veteran and continues to be a leading figure in the region's investment domain. He was involved in setting up two banks in the region, Dubai Bank and Al Khaliji in Qatar. He was the executive director for treasury at Abu-Dhabi Investment Company and later the chief investment officer and head of global markets for Emirates Investment Bank. Biswajit is currently the chief investment officer at Asas Capital and managing director at Global Investment Advisory. Passionate about the space, he advises various financial institutions on strategy and is a guest lecturer at Emirates Institute of Finance. Biswajit, welcome to the show.
Thank you. Pleasure to be here.
Well, I think the best way to start is maybe if you can tell us who is Biswajit on a personal level. So tell me more about yourself.
That's a good question, actually. Almost bordering on the philosophical. But I think if I were to sort of describe myself, the one thing that I try to be increasingly is authentic. I don't, and I don't know if that is sort of a byproduct of growing older, but I don't particularly try to be anything. I just try to put forward what I think is the right thing to do. I try to do what I think is the right thing in any situation without worrying too much about how I will be perceived. I think that's probably the closest I can describe to what I am now.
I can be a testament to that as well. I think through knowing you for more than quite a few years, every time we discuss things, I feel like, it's just an authentic discussion in terms of talking usually about our mixed, like our common passion about investment markets. And I love that. I think what I would like to talk about as well is how did your career journey start in financial services and investment, and how did it become to where it is today?
Interesting data point. Last month, I completed 32 years in UAE. I came here on the 3rd of June, 1992.
Oh, wow. You've seen it all.
So I'm giving away my age here, but yeah. So I did my chartered accountancy in India, and then I joined a corporate house called SRF in Delhi in 1989. And that was in corporate finance, so there was a certain amount of, and income tax. But I always wanted to get into banking, but somehow, and ideally banking that would give me sort of exposure to the wider financial world, which at that time in India wasn't the case. It was pre-opening up of the economy, so banks tended to be somewhat more internally focused. In fact, some of the biggest banks in India today were not even banks then. Like ICICI Bank was actually not even a bank. It was what is called a developmental financial institution. It was meant to support projects. HDFC Bank, which is now, I think, the 4th largest bank in the world by market cap, was only a mortgage finance company. Right? So it was very limited, and I just wanted to understand financial markets and so on. An opportunity came along to join ABN AMRO Bank in Dubai when I was into my 3rd year of my career. And that was in credit, which I jumped at in any case because at least it was, my sort of gateway into banking. I came here, I joined credit, worked in credit for a year and a half, thoroughly enjoyed myself. And then as luck would have it, an opening came up in the treasury department because the head of money markets at that time was moving to private banking. And they asked me if I'd be interested, and I said, of course, So I moved to Treasury in '94, and then I started literally at the bottom of the rung, as would be expected. So I did, nostro balancing and basic FX covering and so on. I was blessed to have a really good boss in that he could see that I was interested in learning and interested in doing new things, and he just kept giving me more and more exposure. So very soon I was, doing FX trading, and then I was heading up the FX trading desk, and then I said, okay, let me try and expand this. So I went and started marketing to subcontinental banks. At some point, I think Ibn Amro was one of the bigger trading houses out of this part of the world. Then we started doing some derivatives. That was very new at that time. So I actually again got the chance to talk to people in London and Amsterdam on how to structure these things. I actually went and looked at things like how to tailor ISDA to suit the local market, because of course nobody was going to sign a 40-page document without understanding it. So I had to sort of make it a little bit more intelligible and so on. And then I started doing structured products. Then I moved into treasury sales, and I started doing structured products and all that. So this was from '94 to '99 end, give or take. And then an opportunity came up in ABN AMRO Kenya, which had then gone through some problems. There was basically a fraud at the ground level, and the regional treasurer wanted me to sort of look at it as an outsider rather than work with somebody on the ground. So I went there in '99 to ABN AMRO Kenya as the treasurer. It was a very, very interesting experience because, of course, there was, of course, the aftermath of the fraud to deal with. But more importantly, I quickly discovered that there was a very easy way to make a lot of money in Kenya, primarily by focusing, attention on treasury as opposed to, corporate banking, which was history. I mean, they had basically built a whole franchise around lending, and that has its usual challenges. You have, delinquent borrowers and things like that. But I quickly realized that actually, because we were ABN AMRO, so there were a few things that were working very well for us. So ABN AMRO, of course, was a Dutch bank, leading bank, etc. But Nairobi is also the head office of UNDP. So a lot of aid into Africa actually comes into Nairobi and then gets distributed out. On top of that, you have a lot of churches which also have their regional offices there. So the money comes in to be used for various philanthropic purposes in Kenya. And we had over time invested time and energy in building up a network in both of these places, right? So we were able to therefore, get all this money in, first of all. So you had dollars or, euros later, but mostly dollars, come in to the market, converted into Kenyan shilling. So there was substantial FX income to be made there, right? Then that shilling was usually kept in deposits, which paid, give or take, 6% return, right? And you could turn around and flip that money into treasury bills, which were paying 11% or 12% or whatever. So it was basically, if you manage your ALM properly, if you just made sure that your asset and liability was well managed, you could make very healthy returns for virtually no risk except sovereign risk, right? So we did that actually, and we did very well for the last 2 years. I was there only for a year and a half, but we basically made most of the money in the bank at that time. But then the bank decided to exit some what it called non-core countries. Kenya was one of them. So they sold to Citi. So since I was there, they said, we'll need you to kind of make the transition happen. So I was part of the sort of divestment team, if you will. So it was interesting because in the space of less than 2 years, I actually built up the business, made a lot of money, and then sold the bank.
Oh, wow.
All of that happened very quickly. So very, very interesting times. But then I came back, and before I could settle into ABN AMRO Bank Dubai again, our ex-head of HR reached out and said, look, we are setting up this bank called Dubai Bank. So MR and Dubai Holdings and all these guys were setting up the bank. And we are looking for people to sort of, start this thing off. And would you be interested in joining? I said, yeah, I mean, at that time, I did not think that I'll have another chance at it. So I said, yeah, I mean, how many times am I going to get a chance to, set up a bank? I said, yeah, of course. So I had an interview with Ahmed bin Brek, who was the CEO then. And he said, yeah, okay. So I was tasked with setting up the treasury and institutional banking for Dubai Bank. Which was, of course, fantastic experience. I mean, I was, I think, employee number 6 or something like that. And we didn't even have our office. He operated out of Amlak's offices that time, which happened to be in Karama, in that near St. Mary's, the church, Udmetha area. So we worked there, worked out of there, and then so I was actually involved in. Okay, the building was chosen by Amar, but literally fitting it out. I mean, everything from the color of the tiles to the carpets to the laying the flooring, so to make sure that the cabling was fine, to selecting hardware, the design, the system, which system will go into it, hiring people, writing out policies, procedures, everything. So absolutely fantastic time, right? Did that, and then so I actually I had a small team, but I think it was a pretty decent team from different parts of the world, and in fact many of them have gone on to do very well thereafter. But we ended up doing some for a bank that was relatively new and relatively small. We were doing some relatively funky stuff. We were trading futures and options. We actually did a CDO, and I am the only man I know who actually bought and sold the CDO and made money off it.
Everyone else lost.
No, everyone lost money, exactly.
Yeah, CDO collateralized debt obligations.
Yeah. And in fact, it was the HSBC, that CDO transaction. So I did. Then I kind of, at some point I felt this is getting a bit crazy. So I sold, I made good money. But anyway, so then in 2006, the bank decided to convert to Islamic. And then some people left. I decided to stay on because Islamic banking was obviously, flavor of the day. And I wanted to understand how it works and so on. So I stayed on for some time. And that was another experience because I actually had to work with converting the bank, so looking at what it means in terms of the contracts, in terms of the structure. And in fact, the man who was doing it in the bank was Adnan Chilwan, who is now the group CEO of Dubai Islamic Bank.
Okay, interesting.
Right, so he was driving it in terms of the conversion, but of course we were all involved. So I did that. I stayed on for another year. And then in 2007, Al-Khaliji reached out to say that, look, we're setting up this bank in Qatar and, would you be interested in joining us and help set it up? So, that was my point about, not getting a chance to set up a bank. I did actually get a chance to set up another bank. Yeah. So I went to Qatar, big bank in terms of capital I guess even by current standards, $1.25 billion capital, 5 GCC countries as shareholders. So my remit was to set up the treasury and debt capital markets. And then along the way, they decided also to set up a small Islamic window, which because of my previous association, they said, why don't you, take a look at that as well. So I did that for 2 years, set it up. And then in 2008, when, just before, the GFC happened, I was asked to build a large structured credit book. And
oh, wow. Speak about that.
Yeah, exactly. And I mean, it was a sizable mandate. They said start with $1 billion and then we build it from there. So I said, look, I need to kind of actually deep dive into this. This is a sizable mandate. So I need to talk to people who are actually managing the assets. And my CEO was very supportive. He said, yeah, go. So then I actually went to the investment banks and I said, look, I don't want to talk to you guys. I want to talk to your credit guys. I mean, you guys are my friends, but I want to understand what's happening, below the hood. So I met a lot of credit desks of all these CDO guys, right? In UK as well as in the US, right? And particularly in the US, it became very clear to me fairly quickly. In fact, it was so obvious that I was a bit concerned that I'm missing something. But to me, it was obvious that this is just something about to blow up. And like I said, I almost could not reconcile to the fact that nobody else is seeing this. So am I missing out something? What's happening here? Right? But I mean, to me, I was seeing these books of assets, with no occupancy, rents not coming in strange locations, loans to people who have no incomes. And I'm saying, I mean, how is this working? I mean, there's something wrong here, right? But anyway, everybody else was buying. So I didn't know how to respond to it. But I came back and I told my CEO that, look, David, I think there's something wrong here. I'm not particularly comfortable about, building a book at this stage of the market. I think something will blow up.
You mind if I give some context? You mind if I give some context?
Of course.
It's very important.
Yeah.
So GFC is the global financial crisis.
Yes.
And that was at a time where such more structured or more complex investment products that had a lot of collateralized debt or more complex debt in them were priced very aggressively, and it was very commonplace to invest in these types of products by large institutions, and a lot of people were not looking under the hood. And here is, someone who's looking under the hood and seeing that issue and avoiding quite a significant drop.
Oh,
and
this would have been wiped out.
Yeah, because you look at Lehman Brothers, right? You're looking at large institutions that have been around for almost a century that, completely overlooked the risk and failed. So,
what was... I know it sounds very easy to kind of say this in hindsight, but I can genuinely say this because you have, the records to prove it. But to your point, so these CDOs were created by essentially pulling together, lots of loans into a securitized package, right? But to make it even more complex, those whole pockets of assets were then tranched into different credit quality, right? So you took, let's say, 100 loans, and you said, okay, these 100 loans are, each of $100,000 each, just to take an example.
And these are loans that the bank has already given to individuals.
Correct.
And now the bank is removing them from their own balance sheet. So it's selling these loans to
investors,
another institution or investors. Yeah.
And
now they're putting them in those tranches.
Yes. So they've taken these pools of loans, and by sort of what I call statistical magic, said, okay, this pool, which is composed of, let's say, triple B quality or double B quality loans, because of the way that, I have tranched it, there is a triple A tranche which will never default because it's like super safe. And then there is a double A tranche which is a little bit thicker, and maybe a triple B tranche which is even thicker, and so on. And then there's an equity piece, right? So the sort of logic that was advanced was, you could invest in the triple A tranche and essentially replicate the loss that a typical triple A tranche would incur, right? And then it became very attractive to investors because now suddenly you had a AAA tranche securities or AAA rated securities.
Yeah, you're saying that's perceived to be super safe.
Super safe. And it was paying you far more than what a normal AAA security would pay.
What a US government bond would pay.
So everybody said, okay, this is fantastic. So pension funds and, insurance companies and all sorts of vulnerable people invested in it.
Yeah. And you would assume these people are professional investors.
Exactly.
Yeah.
Exactly. And that's why I was frankly very tentative initially. I said, this is, how can I have found something that all these people have not found?
Yeah. Right? How could it be that easy?
Yeah. Right. So I actually, went and talked to the rating agencies to try to understand what I wasn't sure I had missed. So I said, can you please explain to me how, from this pool of triple B or whatever double B assets, you've created this, triple A tranche and so on. It was clear to me after 15 minutes that they did not understand. They essentially just, swallowed whatever they had been told by the investment banks.
Sales traders.
Yeah, completely.
Yeah.
They had no idea.
Yeah.
So I got, at least that gave me some confidence that I'm onto something here, right? In any case, I mean, I wish I knew how to short this. I didn't know. I'd probably be, sitting in a very different place if I had shorted it.
Yeah, a good movie about that is The Big Short, which is essentially about a team of or different people. I've recognized that.
Yes.
They were so surprised about how, blatantly and ahead of them it is, and then went and figured out ways to actually profit from it and by shorting it, which means actually betting against
it.
This
that I hadn't figured out. So, but I basically knew that I don't want to be part of this. So anyway, I came back and I told my CEO this, and he wasn't particularly happy. He thought, I'm missing something, and he, basically said, this is not working. All these guys are making so much money and so on, and how can you say this? Anyway, so I thought it was probably good that I leave the organization. In any case, I was looking forward to getting a little more engaged with the wider professional world, which at that time in Doha wasn't that easy to do. So I put in my papers. As luck would happen, between the time I put in my papers and my actually leaving, the world basically fell apart.
Yeah.
So during my gardening leave, everything fell apart. So I guess I felt quite a bit vindicated. But anyway, so I came to Abu Dhabi Investment Company at that time, and it was, I think with the benefit of hindsight, a once in a lifetime kind of situation. Abu Dhabi government issued debt at that time at a spread of 400 basis points.
So a spread of 400 basis points, meaning we're paying 4% more than the US government.
Correct.
And you're talking about Abu Dhabi government, which runs such a big surplus that they don't really even need to raise that. So
they basically did it to create a yield curve. That's all.
So essentially that was almost, for whoever was looking for, that was almost free money.
Free money, absolutely.
Yeah, lending the Abu Dhabi government money who doesn't need it, and they're paying you a very healthy return for it. Yeah.
So this time I did figure out how to amplify the return. So I went to many large banks in Europe, mostly in Europe, so Europe and UK. And I told them, look, what is your biggest problem right now? Counterparty risk, right? You don't know who to lend to because you don't know what their balance sheets are and what blows up in your face, and therefore you don't want to lend to anybody,
especially after the crisis.
Yeah. So you're sitting on these piles of cash which are earning you nothing because interest rates had become nothing, right? But you don't know who to lend to. And I said, look, I'm Abu Dhabi government. I mean, my charter was signed by Sheikh Zayed, and I'm as close to Abu Dhabi government as I can be. Right. And what better counterparty risk do you have in the world today?
Yeah.
Right. Most of them bought that. So I ended up with a very nice pile of borrowing from all these guys, which I then flipped and put into these things.
Yeah.
So I basically made, I think, the entity's budget for 2-3 years.
Very nice.
Basically just by borrowing this and buying Abu Dhabi government securities. So that was really a good way to kind of start things off. And then that also gave me the breathing space to then reconfigure the entire treasury and trading operation, because now I knew I don't have to worry about making money. That money is getting made, right? So the treasury had historically been a sort of a servicing unit to ADIA.
Abu
Dhabi Investment Authority. So the skills that were there were not in line with what I wanted to do, which was more of a profit-oriented, commercially oriented organization. They were more execution type people. So I had to completely revamp the organization. I had to let go of a lot of people. I had to get in a lot of people. And then we started, again, I said, look, to everybody who would listen, I basically said, look, I'm of the government. So you don't have counterparty risk, right? You just focus on the pricing. If you don't like the pricing, obviously that's an issue. But otherwise, we are here. We are open. We don't have things under our closets that you will be suddenly surprised with. It's all very clean, very whatever. So we started trading everything from FX to fixed income to equities and so on. And again, because we were there and we were able to kind of do this, and I had good people, so we were able to make good money from that. Also, because it was that time in the markets, it was possible to get allocation to, for instance, Facebook. I got allocation in IPO, right? Because again, how many people were bidding at that time?
Yeah, different times.
Right. So yeah. So those 3-4 years were really, really very interesting. And then along the way, my own remit expanded a little bit because the entity also had a lot of private market investments acquired historically, and there were all sorts of, it's a very motley sort of whatever. Set of investments. So there was a company that was into telecom towers in Egypt. There's a company which was into logistics in Turkey. There was an airport in the region. There was a shipping company. There was a fleet of cars. All sorts of different businesses, right? Which would all come to the investment committee for essentially taking money. Yeah. They would come and say, okay, I need capital to do this, that, and the other, right? And after some time, I said, look, I mean, this was an internal conversation with the, addict team. None of us has any understanding of these businesses. We're really listening to what management tells us, right? And writing checks, right? I don't think this is how we should be running the business. I mean, we are financial people. We don't understand how to build telecom towers or what the challenges are and what's happening on the ground in Egypt or what are the logistics issues in Turkey. You can get a high level understanding, but it's not deep enough for you to really, take investment calls on these things. So I think we should be getting out of these things and focusing our energies on things that we can control and, have better insight into. My CEO agreed. He said, yeah, I think this is... so we set about doing that, but obviously, easier said than done, because getting rid of these businesses one by one is a very lengthy and a very complicated process. It went on for very long. I left before it was complete. Toward the end of it, I think 1 or 2 assets were still left when I left the organization. So what happened was, when I was at ADIC, the CEO of Emirates Investment Bank actually came down to sort of solicit ADIC as a customer. He was selling some of his products to us. So I think hit it off, and even though I didn't buy anything from him, but I think it was a good conversation and so on, and we kept in touch. And then somewhere along the way, he reached out and said, look, I'm looking to sort of revamp the treasury and sort of make it a different kind of organization. We are very reactive. We don't do much. Would you be interested in kind of, actually, he didn't say that. He said, do you know somebody who can help me do that? So I said, okay, let me come and talk to you and see what's going on. So we had several conversations. Then it felt like something that I wanted to do, because it basically meant completely taking over responsibility for everything that the bank did as a proprietary organization. So there was a sales side, which is asset management and wealth and all that, which was managed by other people. But anything that the bank did on its own account was part of the remit. So I came over in 2014, beginning as CIO. And there the remit was treasury, prop investments, trading, and product development. So like I said, everything that the bank did on its own account. So that I did for 7 years. Again, very interesting, because historically it had basically been an ALM type function. Not much was going on. We again changed that completely. It became much more about products, about new ideas, about new trades. We built up the investment book quite significantly. and not just in terms of size, but also in terms of asset classes. So already I was doing a lot of private market investments at Adik, and in EIB that expanded. So we started doing lot more asset classes, lot more geographies. Uh, of course, fixed income was still at the core, but fixed income also became far more diversified, both in terms of maturity and duration, and in terms of geography also. So product development also, we actually started then using the balance sheet to do products and all that, which earlier wasn't being done. So we did quite a bit of stuff on again, frankly, all usual asset classes, so everything from real estate to stocks and bonds and FX and interest rates and so on.
And this is mostly for the bank and not for the clients? Or
for the clients.
For
so
the
we
clients,
would use the balance sheet to create the structure, and then we would sell it to clients.
Yeah.
So we did quite a bit of that. And then, so real estate, then we also started doing things that I think even now not that many people do, which is actually, what is fairly common in other parts of the world. So you equity release products. So we started actually, lending against owned assets, right? Not as 15-year mortgages, but as a 1 or 2 year transaction and so on. Right? So long as the asset could give you a first lien, we were happy. So that was another very interesting one because, of course, a lot of people had, substantial amounts of money locked up in the real estate. And they were happy to, have access to 50-60% of that money at slightly high rates, but still significantly lower than what they were paying in their business.
Yeah.
Right. So that and continues to be a very successful product. And along the way, of course, that also was helpful because we tried to make sure that even though we would allow cash withdrawal, a certain part of the cash was deployed in AUMs with the bank. So, it was a bit of a self-serving mechanism in a way, but it helped everybody. I mean, he had liquidity released to him, and we had AUMs on that. So that continued for a while, and then for a brief period, I was even responsible for the private banking side. The head of private banking left to go back to the UK. So for about a year and a half, the bank said, do you want to look at the private banking side of it as well? So I was responsible for that also. And then in October 2020, sort of almost at the end of the COVID whatever situation, I decided to do what I had always wanted to do, but until then hadn't really done it. I suppose I needed some sort of a trigger, which is to do something on my own. So I was actually I put in my papers, and I was actually in the process of setting up when a friend of mine. I was having lunch with him, and he said, why do you want to go through the hassle of setting up, spend all your time and energy in basically the administrative stuff of setting up and so on. If you want, you can join me. We can work together. We've known each other. We know how we work. See if it works for you. If it doesn't, you go through the same thing in a year's time. At least you will have by then established yourself as a, in terms of the business and so on. And it'll probably be easier, and you wouldn't have lost anything anyway, which kind of made sense to me. So I said, yeah, okay. So I kind of started that. And then my one of my big clients at that time was Asas Capital, who was at that time sort of trying to upgrade their investment advisory and product piece and so on. So I initially signed up for a half-day thing to help them with some of that while I was doing other things. And then about a year into that, Himanshu was the CEO. He said, you're spending most of your time here anyway. Why don't you sort of join us? And you continue to do whatever else you want to do. I don't have a problem, but at least you become part of the team. Which again, to me, made sense to me at that time. So I said, yeah. So yeah, so at the moment that's what I am. So I'm doing
Nice.
I'm yeah CIO at Asas, which means I look after the investment advisory and product advisory part of Asas, and I have some sort of investment banking type mandates on the side, which I advisory and mandate and yeah fundraising mandates on the side, which I also do.
Great. Well, thank you for that. I think now it would be good to pick your brain on some like key topics that are very interesting today based on that background. And what we see over the past 3 years now, maybe even 4 since COVID, the main driving factor of what has impacted markets the most has been a rise in inflation, and then followed by a very large hike in interest rates. And what's very interesting about that is the most people it's affected are people who are actually low risk investors, who are investors who were invested in sukuk or bonds or lower risk investments looking for fixed income. But they were fixed in income in investments that were lower yielding at the time and have probably got the biggest brunt of that effect. So what do you think about how interest rates have gone up, inflation? Now we're seeing inflation coming down, a prediction where interest rates are coming down. So what's your thoughts on this current market and how that will impact investors?
So look, the interest rate cycle, which tends to be pretty long. I mean, we've had a period of declining interest rates at least from, let's say, 2008 onwards up until 2021 end, right? Interest rates basically came down and stayed low, right? And as a result, the opportunity cost of not being invested in something or the other became very high. So it was easy to borrow cheap and invest in anything, literally. And as a result, you had every asset class going up in price, right? Equities did fantastically well. Real estate did well. Bonds did well, right? Because as you know, bond yields, if the interest rates go down, then bonds that are priced at a higher interest rate will automatically go up in price,
And they're more in
right?
demand.
So they all did very well. And then we had 2022 when the Federal Reserve had to sort of backpedal on its earlier stance of inflation being transitory and decided to aggressively raise interest rates because they felt inflation was getting out of hand. And we did have some very high prints on inflation at that time. And the highest was 9.1 in June of that year. So as a result, I guess the Federal Reserve had no choice but to raise interest rates. And it because to a certain extent, the interest rates were sort of much higher than expected. And also because they were a little bit behind the curve, they ended up raising interest rates at the fastest pace in history. Right. So you had jumps of 75 basis, 75 basis, 75 basis, 50 basis, and so on. So in a very short span of time, you had a very, very high hike in interest rates. And of course, that meant that any asset that had been financed by lower interest rates were now having to be financed by high interest rates. And as a result, whatever income was generated by that asset now was lower in comparison to what the interest rates were. So the prices of those things fell. And as a result, you had, for the first time in a very, very long time, stocks and bonds falling together.
Yeah.
Right. Historically, you had this sort of situation where stocks and bonds usually move in opposite directions, but that was not the case this time around, where both fell, right? And by very sharp sort of margins in both cases. So since then, what has happened is, even though interest rates have remained high, there have been other factors that have allowed stock prices to recover quite a bit. So you've had, for one, the whole optimism around artificial intelligence and how that is going to transform the world. As a result, you've had companies like Nvidia, which have skyrocketed in value. super microcomputers. So a lot of these guys, ASML, TSMC, all these guys who manufacture semiconductors and chips and are basically in that space, they've all skyrocketed in value. Also, what are being called hyperscalers. So some of these very big technology companies, which have the balance sheet and the muscle to invest very large amounts of money into building capacity in AI and access to data in different ways.
Yeah.
Right. So they are able to therefore position themselves in a way that smaller companies would really struggle to match. Right. So as a result, you had this, at least at the index level, stocks really doing very well. If you looked below the hood, you would find that really the stocks that did well were a few, what was called Magnificent Seven at that time. So we had this phenomenon for almost a year of, seven stocks which basically carried the index, and the 493 which did very little, right? So any which way, at least stocks kind of recovered a lot of the losses that they had gone through in 2022, and as we speak, they are now at all-time highs. So a lot of the losses have been recovered. At the index level, I don't necessarily feel that portfolios have recovered to the same extent, because portfolios were diversified. So it's not as if everybody owned only these seven stocks and nothing else.
Yeah.
So right. So a lot of other stuff hasn't done so well, right? As an example, and these included some very very good names. So Pfizer as an example, or PayPal. These the really good companies which were considered stock market darlings at one time, have sort of crashed and haven't recovered, and you really don't know how long it's going to take to recover. So you had this situation where stocks, at least at the index level, have done well, and now maybe there is some rotation into cheaper stocks as well. But overall, stock markets have kind of picked up. Bonds, on the other hand, are much more closely linked to interest rates, right? So frankly, that's, I would say, if I were to rank the factors that influence bonds, I think that's probably, at least at the short end, interest rates are number one, right? And as inflation sort of started to come off from 9.1 to around 3 handle right now, that it is currently, expectations built up in the market that interest rates will now have to be lowered, right? In fact, going into this year, the market was expecting as many as 7 rate cuts, right? And the whole market was positioned to kind of benefit from that. I had questioned earlier, and it turned out to be correct. Is that if you have a situation where you have raised interest rates, and despite that, the economy by many metrics is not doing badly at all. Your unemployment numbers are still close to 60-year lows, right? Corporate earnings are okay. Stock market is doing well. Why would you cut rates? Why wouldn't you preserve gunpowder for when things really get bad, right? So I wasn't particularly in the camp of an imminent, cut in rates in the way that the market was, and you saw that sort of narrative going on in terms of extending the time for rate cuts to happen, and really, I think for me, the sort of the thing to watch was how unemployment moves, because if employment numbers soften, then that would be the trigger for the Fed to move, because it has a dual mandate, right? It has price stability and full employment,
Yep.
right? Price stability is not quite there, but moving in the right direction, almost there, right? It's not 2%, but it's at least 3%. And some of the sort of structural reasons for the inflation, which was, supply chain type issues, most of them have been resolved to a large extent. So I felt that at least the direction is positive, and we've had multiple readings that are suggesting we are in the 3% handle. But now unemployment has finally started ticking up, right, from 3.4 to 4.1 in the last 4 months, which is still by historical metrics not high, but it is quite a bit higher in absolute terms compared to what it was for all these months, right? And also because you know the 4% today is not the same as 4% maybe in the 1980s and 90s, when it was typically one breadwinner household.
Yeah.
Typically there were the man of the house used to typically earn, and the lady of the house used to look after the house, right? So a 4% in that context is very different from a 4% today, where very rarely one breadwinner. It's usually two, and sometimes even each one of them is working two jobs.
Yeah.
Right. So the 4% is far more magnified today than would be the case earlier.
Indeed.
So, and historically, if you see, unemployment has a tendency to, when it starts reversing, it shoots up. It doesn't go up gradually, right? So there is a tendency to do that, and therefore, the Federal Reserve, I'm sure, is well aware of that. And now I think there is pressure building up to cut rates. Uh, Now, having said that, I am not yet convinced that inflation will go back to the 2% handle that they are kind of targeting, for a few reasons. One is one of the sort of basic factors that was driving disinflation was globalization.
Yeah.
Right? Everything that is made in China is sold in the US, and therefore you had costs come down in the US, because of course China was manufacturing it at a fraction of the cost, and so on. Right? Now, because of this whole geopolitical tensions, etc., this concept of near-shoring, building up resilience in supply chains and so on, people are moving their supply, from only China into multiple locations and so on.
Becomes more expensive to produce.
Correct. So by default, that means your cost will go up, right? Because you are no longer focused on the cheapest source, but you are trying to build up some resilience, and therefore you're going to maybe less cheap, not necessarily as expensive as it would be the case in the US, but not as cheap as it was in China, right? So you have that issue. In China itself, cost of production has gone up because wages have gone up, right? So Chinese wages are no longer what they were 20 years ago, right? So you have both of those things. So you have that side, right? So that is one factor which I think will keep prices high. Two is things like insurance have become and will become expensive because climate change, right? You cannot. I mean, insurance companies don't know how to price, all the changes that are happening as a result of climate change. You have more, extreme weather conditions. You have hurricanes and typhoons and, extreme heat and all these kind of things. Insurance companies don't know how to, price this today.
And
so if you don't know, what will you do? You will price it very high. Because you don't know. You have no means to say, okay, let me fine tune this and keep it as close to whatever. You'll price it high, right? And you'll price it and you'll pass it on to homeowners, right? So you have this dynamic as well. Population itself are declining. So you have cost of wages, etc., also going up. So there's a whole bunch of factors that, in my opinion, will not allow inflation to go back to the 2% handle that the Fed is targeting immediately, at least, right? So so I think interest rates will go down from 5.5, 5.25, 5.5 to, I would say, maybe 350, 375, something like that. But I don't see that going down to 2% just yet. Right? On top of that, I have another, which I hope doesn't happen, but I am concerned that there is the real possibility of that happening. See, you have the US debt, federal debt, which has become 3 times what it was in 2009. Right? In 2009, US federal debt was $9 trillion. Now it is $35 trillion and change. Right? The debt to GDP, which is a metric of the productive capacity and the ability to service the debt, is now at 120% plus. Right? The interest cost is more today for the US than defense spending. It is more than what is healthcare.
The cost to just service
The cost of servicing the debt, right? So, and by their own estimate, the Congressional Budget Office, right, which forecasts, how the economy will play out based on data that they have today, they are expecting the 35 trillion to go up to easily 40 trillion plus in the next few years, right? And debt to GDP not going down. In fact, deficit, which is today around 5% and change, likely to go to 7% by the turn of this decade, right? So you have an economy that is likely to continue to be under stress for a while. Politicians are not known to be frugal and prudent in spending, right?
No one is talking about low, but everyone's talking
about it, right? And it is a politically very difficult thing to do.
Yeah.
Once you've given money away, it's very difficult to take money back from the public.
Either raising taxes, either reducing budgets.
Correct. It's very difficult to
don't win.
Very difficult to do. Yeah. So I don't see that happening. So you have these pressures that are there, right? In terms of, the government needing more money, right? So this is one side of the story where you have more debt service, more stress in terms of the economy and so on. On the other side, if you look at who has been the biggest investors into US debt, right? China. Right? If you look at China's holding of US debt, it has gone down in the last 10 years from 1.3 trillion to below 800 million, right? It's about $600 billion less, right? Japan is still holding up, but if Japan does raise interest rates, which is a likelihood, right? Because, they have to raise because their inflation numbers are actually higher than what they would expect. The flow of Japanese money into US treasuries will go down. Right? Russia has already sold all its US debt. Right? Even Saudi Arabia, for that matter, has lower US debt than it used to be. So my worry is that you will have high debt, right, and low demand hitting at the same time. The traditional buyers of debt will not buy because they're not buying because of geopolitical reasons, right? While you will keep issuing more debt because you're borrowing more. So what do? Then you have to raise interest rates, right? The return that investors will need to invest in that will be higher than what it is today, right? So even if your short-term rates go down, your long-term rates may not go down that much. So
then it becomes a byproduct of yet again printing and buying those, which is a continuation.
Yes.
So few questions I have for you. I think one important question is your career has been very much focused on investing on a professional level. So how different is it investing or advising on investing or investing on a professional level from an institutional level, from an individual level?
So a couple of things, right? One is the average individual, and I'm being very broad brush here. So obviously there are exceptions and there are all sorts of, but the average individual is far too interested in immediate returns, in what is the flavor of the day, right? And in sort of getting swayed by emotions, right? Without looking at what his ultimate objectives are, what his own risk appetite is, without really understanding how strong the news flow is justified in terms of the fundamentals and so on. So you end up with investors doing, frankly, the exact opposite of what they should be doing when they're managing money themselves, right? So they will, buy stocks when stocks have become expensive because, now it is suddenly fashionable to become invested in AI, for instance, or some such thing, right? And actually ignore the ones which have become valuable and attractive, right? They will sell at precisely the wrong time because, suddenly the narrative has turned against and now nobody wants to look at tech or some such thing. And they will get rid of, everything at precisely the wrong time when prices have dropped. And the problem with that is you incur permanent loss of capital. You bought at high and you sold at low.
You used to own a company, you used to own something tangible, and you've sold it. That's it. Yeah.
and you basically crystallize the loss.
Yeah.
Right. Whereas if you had held on to, some of these companies, you'd probably be okay. Right. And I can give some extreme examples, but I mean, Amazon, for instance, in 2000, when the .com happened, right, fell all the way from $100 to $6. Right. And look at what it is now.
Oh, wow. Yeah.
Right. So if you had held on to it, or Microsoft, same thing, right? You had to hold on to it for a very long time, but eventually it paid off. So, and I'm not suggesting it's easy, but I'm saying you have to have a thesis as to why you are investing. What is the purpose of, putting this money aside, rather than this sort of, shotgun approach to whatever is most interesting at this point in time, and then, getting burnt for it.
And we always talk about the region as well in terms of investing on a personal level. Is, the advisory space is quite nascent here in the region. So, what has your experience been within speaking to close associates who might look to you for advice in terms of what is their experience in the market? Has there been good advice? Have they made the right decisions? So specifically about the region we are in.
So, I always like to give the example of a doctor, right? If you had, a health situation, right? Would you take advice from the guy who's the medical representative of a pharma company?
No, I think most people wouldn't.
Wouldn't, right? Because you would know that his independence is compromised. He's going to, sell to you what he is getting a commission for.
Yeah.
But people do the exact same thing when they go and seek out financial advice. They'll go to the bank or bank advisor, right, who is paid by the bank, right? And the bank makes money by encouraging more transactions and selling its own products, right? And they will take advice from that person. It just makes no sense. You would much rather take advice from somebody who is getting paid by you and therefore has his allegiance to you.
Sure.
Right. But somehow this part of the world hasn't caught on. I mean, in the US, for instance, things have changed. Now people go to, independent advisors to kind of, seek out financial advice. And these guys, because they are paid by their clients, they are incented to make sure that the client does well year after year after year, because then that ensures that, he himself gets paid.
Sure. And why do you think that model has matured in other markets such as the US, but not yet in the UAE? Is it a factor of time, or is it something unique to our region that we still haven't grasped that concept of having a more mature industry of good advice and good guidance for individual investors on how to allocate and how to meet their objectives?
So, this is a very good one, and I honestly have not that clear an answer. The only thing I can tell you is that every time that there's a market correction, and suddenly people realize, oh my goodness, the incentives are completely misaligned, and I paid my advisor all this money when markets were good, but now that markets are bad, he's kind of margin called me out, or he has really nothing. He's not hurting. I'm the only one who's hurting because of my portfolio going down. That you see these brief flickers of awareness, and some people start to think about these things. As it has happened the last few years, we haven't really had a sustained correction, right? So people have got lulled into this sort of story, in my opinion, of oh, the bank is paying this guy and I don't have to pay. I mean, how can the bank pay?
Yeah, they're not doing it out of kindness of hearts at that.
Exactly. The bank is paying from your money. Yeah. Right? And obviously, if it's paying somebody from your money, it is keeping something for itself. So therefore, it makes sense for you to do it yourself, obviously. Yeah. But somehow that fact seems to get lost, and people. So the other thing that is very, very, I guess, peculiar, I think, to a certain extent in this part of the world, and maybe even in Southeast Asia to some extent, is this fondness for structured products, right? Which is essentially products which convert movements in underlying assets into an income stream.
Yeah, more complex financial instruments.
Yes,
that are How could we explain that further? They're more complex. They're about giving an income stream, but then they have different types of risk or different types of allocations towards risk.
What most people don't seem to understand, and I guess partly they've lucked out because the markets have mostly been helpful so far, is that they are actually taking on all the risk for a little bit of return. They are the ones who are providing the insurance.
Yeah.
In the structured products, they are the ones who are providing the insurance. In case things go wrong, they are the ones who are taking the risk. And they don't participate in the upside. Somebody else participates in the upside.
Agreed. I think we could do a whole episode speaking about structured products.
Yes.
I think it's a good idea.
Yes.
I know that we've gone on time, and thank you so much for your insights.
No,
and definitely should continue
always
that conversation.
Good, fun to have this conversation.
Thank you so much.